Okay, so you did it. You found the house, the one. The excitement is probably through the roof, right? But now comes that final stretch. The part that's filled with all that paperwork and these confusing fees that can feel, well, a little intimidating. But don't you worry, we are going to break it all down step by step. Think of this as the final boss battle. You've already navigated this crazy market, you probably won a bidding war, and now the only thing standing between you and those shiny new keys is a stack of paper and a list of costs. But honestly, it is totally manageable once you know what's coming.
All right, so here's the game plan for getting you across that finish line. First up, we're going to tackle that mountain of paperwork, what you actually need. Then we'll introduce you to the team that's working for you behind the scenes. We're going to pull back the curtain on the most mysterious part, the underwriter's review. After that, we'll decode those closing costs so they actually make sense. And we'll wrap up with a super important warning about the one thing you have to do right before closing, which is to do absolutely nothing. Seriously.
Okay, first things first, your paper trail. At the end of the day, a lender's main goal is just to verify who you are, how much you make, and what you own. It's all about proving you are who you say you are and that you can comfortably afford this new loan. I like to think of this as your financial autobiography. Your ID and social, that's the cover page. Your W-2s tell the story of your past earnings, and the pay stubs show what's happening right now. And bank statements prove you've got the cash for this next chapter. Oh, and here's a pro tip. When they ask for bank statements, they mean every single page, even the blank ones. It sounds weird, I know, but it's just how they verify that nothing's been left out. It's all about creating a complete, unbroken story of your finances. So what lenders are really looking for is stability. If you're a W-2 employee, that's pretty easy to show. But if you're self-employed, your income might look more like a roller coaster, right? Lenders need to see a longer history. We're talking 2 full years of tax returns, just so they can find the average and make sure your business is on solid footing. And they'll probably ask for a recent profit and loss statement too, just to see how things are going at this very moment. The good news is you are not navigating this paperwork jungle alone. There's a whole team of specialists whose entire job is to get your loan from that first application all the way to the closing table. So let's meet them. This table breaks it down perfectly. Your loan officer, they're like your travel agent, helping you find the perfect loan product for your destination. The processor is kind of like the librarian, meticulously collecting and organizing every single document for your file. And then there's the underwriter. They're the judge, and they make the final call. All right, let's zoom in on that final role because it's the most important one, the underwriter. This is the most critical person in the entire process. And fun fact, you'll probably never even speak to them. Their entire job is to protect the lender from taking on too much risk. And believe me, they take it very, very seriously. So what do they actually do? Simply put, they're the gatekeeper. They take that perfectly organized file from the processor, review every last detail, and decide if you meet all the lender's rules. They have the final say, yes or no. So how does one person make such a huge decision? Well, they use a framework called the 3 C's. First is credit. What's your history like? Do you have a good track record of paying your bills on time? Second is capacity. Can you afford this new payment right now? This is where they calculate your debt-to-income ratio, or DTI. They literally add up all your monthly debts plus this new mortgage payment, and they divide it by your monthly income before taxes. If that number's too high, that's a red flag. And finally, collateral, the house itself. They look at the appraisal to make sure that if, worst case scenario, you stop paying, the house is actually worth what they're lending you. Okay, you passed the underwriting test. Huge sigh of relief. But now comes the second big hurdle, the money. Let's talk about closing costs. These are basically all the fees you have to pay to finalize the loan and officially get the property put in your name. A good rule of thumb is that your closing costs are going to land somewhere between 2 to 5% of the home's purchase price. Now, I know a percentage doesn't always sound like much, but let's put that into actual dollars. Yeah, for a $300,000 home, that 2 to 5% suddenly becomes an extra $6,000 to $15,000 in cash you need to have ready. And this is on top of your down payment. Honestly, this is the number that catches so many buyers completely by surprise. So when you get your official loan documents, the list of fees can look a mile long and kind of terrifying, but they really all fall into 3 simple buckets. You've got fees that go straight to the lender, fees for third parties like the appraiser and title company, and then stuff you pay in advance, like property taxes and your first year of homeowner's insurance. Let's hit a few of the big ones. The origination fee. That's what the lender charges you for, creating the loan. Title insurance is a third-party fee that protects both you and the lender from any weird ownership claims down the road. And the prepaids are exactly what they sound like. You're paying for things like homeowner's insurance and a couple months of property taxes upfront. This puts a little cushion in your escrow account so the money's there to pay those bills when they're due. So, you're approved, you know the costs, you can practically smell the new paint. You are so close. But now you enter what might be the most critical phase of all, the quiet period. This is the time between your final loan approval and closing day, and what you do or don't do here is everything. And here's why it is so dang important. Your approval was based on a snapshot of your finances at a specific moment in time. The lender needs to make absolutely sure that snapshot is still accurate right before they wire hundreds of thousands of dollars. Any major changes can throw the whole loan into jeopardy. So listen up, because this is your do not list. The best advice I can give you is to just freeze your financial life. I'm serious. Hide your credit cards. Do not go furniture shopping for the new house yet. Do not finance a new car for that beautiful new garage. And for the love of all that is holy, do not change or quit your job. Any one of these things can change your credit score or that super important debt-to-income ratio, and that could trigger a last-minute panic with the underwriter. You do not want that. And really, that's it. By understanding the documents you need, the people on your team, the real costs involved, and the rules of that final quiet period, you've basically turned this big, confusing process into a clear, manageable set of steps. You are now ready to walk into that closing office with total confidence and finally get your keys.
So you've got the keys in your hand. Congratulations. That's an amazing feeling. But that mortgage and those closing costs, that was just the price of admission. The true cost of ownership includes the leaky faucet you didn't notice, the property taxes that always seem to go up, and the furnace that decides to die in the dead of winter. So the real question isn't just can you buy the house, it's are you ready to truly own it?